Hello everyone, welcome back to the channel. In today's video, I'm going to be sharing the 5 most important lessons I learned from reading my favorite finance book of all time, The Psychology of Money by Morgan Housel. Lesson 1. Everyone's perspective on investing is based on their unique experience of life. We all come from different backgrounds. We are parents from different generations, who are from different parts of the world, who all earn different amounts of money. And that can shape your beliefs when it comes to money and investing. Think about it. Someone who grew up in complete poverty and fear will evaluate the risk to reward for certain investment decisions very differently to someone who grew up in a very wealthy family. Similarly, couples who had mortgages in the 1990s, a time where interest rates were double digits, will view debt so differently to couples who were able to get mortgages with interest rates as cheap as 2% in the 2010s. The key point here is that when you're taking advice from others about investing, just remember their background shapes their perspective. What might be crazy to me may not be crazy to you. And that's only because we've experienced different parts of the spectrum. We all have different financial goals, investing timelines, things we want to buy. And so all of these things and the things we've been through in the past shapes our perspective. There's no right or wrong in this game of investing. So the next time you find yourself in a mortgage versus rent debate for the 58th time with your parents or your friends, or you're trying to defend your appetite for crypto investments, keep in mind, everyone is biased by their own experiences. The compound effect is the greatest weapon you have to grow your wealth, but it needs time to work. Let's talk about the legendary Warren Buffett, a name that everyone knows in the investing space. He's worth over 130 billion, but what's more fascinating than that is his journey. He started investing at the age of 10 and he's currently 94, which means he's been investing for the last 84 years of his life. But here's an interesting thought. Let's take it back in time and let's say Warren Buffett took the path that most people tend to take around their 20s. You know, enjoying his 20s, not worrying too much about money, traveling, exploring passions, and maybe only getting serious about investing at the age of 30. And let's say he retired around the age of 60 like most people to enjoy his retirement. If he had done that, instead of having $140 billion, he would only have 19 million. Now don't get me wrong, $19 million is a lot of money, but compared to what he has now, it's not even 0.1%. This really shows the power of the compound effect and how much you can gain when you just start early and give yourself a long investing timeline. Now let's talk about how the compound effect can work for you. Imagine you're a university graduate, just like myself, and you're on an average salary. That would be £38,500. Now I'm aware that this is the mean. Unfortunately, I've tried to find a median, but I could not find a statistic on the internet. But let's just go over the mean for the time being. £38,500, which is roughly $51,500 a year, is approximately $4,290 per month. Now, if you follow the common logical advice of saving 20% of your paycheck every month, you would be dedicating $858 to your investments every month. So what happens if you invest $858 a month for the next 20 years into the S&P 500, assuming an annual average return of 8% a year? Let's check it out. At first, it feels like not much is happening. The growth is very slow and the results might seem modest, but this is where the magic of compounding kicks in. Within just 7 years, you'd have your hands on your first $100,000 and it would all be invested in the stock market. Now, you might think 7 years is a long time. I agree, but when you look at relative to your investing timeline, an investing timeline which should be around 40 to 70 years, 7 years is just the beginning. This is why the compound effect is so useful when it comes to building wealth. If you want to take advantage of it, just like Warren Buffett did, you're gonna have to give yourself a very long investing timeline. And so the earlier you start, the better your results. Time in the market beats timing the market. A lot of us tend to overcomplicate investing. Why? Because we're so worried about losing it all. And so we can get caught up in the latest headlines or economic problems that are going on in the world right now. Whatever the case may be, high interest rates, inflation concerns, US elections, geopolitical tensions, it's so easy to think, now's not the right time, I'll just keep waiting. And that leaves you waiting and waiting and waiting and waiting, and eventually you realize you've let so much time pass and you've not actually done anything with your money. If you have a long-term investing timeline, these are just short-term concerns that are necessary for the journey. Let me give you some perspective to help you understand it. Over the last 150 years, the quality of life has increased 20-fold, and this happened despite 9 major wars, the failure of 99.9% of all businesses that were ever created, the death of 4 US presidents via assassinations, 33 recessions that lasted a total of 48 years, and the market dropping by 10% or more at least 102 times. Not to mention inflation soaring above 7% on at least 20 occasions. Now, despite all of that, the market and the world has kept moving forward. This graph shows it all. It shows the long-term real growth in the US GDP per capita from 1871 to 2009, and it's adjusted for inflation. What you see here is a steady upward trend, despite all of the roadblocks that I've just mentioned. This is exactly why time in the market beats trying to time the market, because there's always going to be downturns, there's always going to be recoveries and corrections. If anything, you should look at that as an opportunity to invest more capital so you can let the compound effect work in your favor. Lesson number 4, everything has a price. Let's talk about the real price of investing, and no, I do not mean dollars. The truth is, the bigger the potential reward, the bigger the emotional cost you're gonna have to pay. We're talking about dealing with fear, uncertainty, regret, the mental stress that comes with successful investing. It's human nature to want to overlook these intangible costs. If you can train your brain to identify intangible costs and figure out what exactly you're paying, you will save yourself from the stress and surprise that you experience when you're going through it, because that's when most people truly realize what they're paying for their investments. When I first read this in the book, I instantly thought back to last year where I made 100% from one trade in the crypto markets. And it sounds like a big win, and it was. But then I asked myself, what did it really cost me? When I factor in the intangibles, what did I pay to achieve that 100% return on investment and have that big win under my track record? 3 long months of sitting through 25% drawdown, volatile price action, and occasionally questioning my decision making. That was the emotional toll, which was the hidden price of these high returns I achieved. So here's the takeaway. Whenever you choose an investment, truly identify the intangible costs that you are expected to pay, so you aren't caught by surprise. Lower rewards are associated with lower costs, and conversely, higher rewards are associated with higher costs. There is no right and wrong, okay? At the end of the day, you are the one that's going to be investing, and you're the one that's gonna have to pay these costs. It's your hard-earned money, so just do what you're comfortable with. If you don't think you can stomach consistent drawdown periods, which is completely normal, then don't get involved in crypto. If you're someone that wants stable but low returns, invest into the S&P 500. If you're someone that values bricks and mortar, look towards having a real estate portfolio. What works for you, works for you. Just remember, you can't expect to have big rewards in life and not be willing to pay for it. Lesson 5, the desire for something to be true can cloud your judgment. Have you ever wondered why so many people fall for these get-rich-quick money schemes? Money is a tool that has the power to completely change your life, and just the thought of something working in your favor and becoming really rich can completely make you lose touch with reality. We've all experienced this before. It's why so many people are addicted to gambling. It's why millions of dollars are invested into meme coins that have no utility. And it's also the reason why a couple years ago, I invested into 8 NFTs and lost every single penny. I was 18 at the time, and looking back, I was so delusional that the concept of becoming so rich from these NFTs made me blind to reality. This is the mentality a lot of people in the markets have, and when you're aware of it, you can look at people who make these decisions and understand them. I look at the crypto markets and I completely understand why it is the way it is. Ridiculous returns are promised for minimal reward. As a result, people are buying without having done any research, buying based on what they've seen on the internet, holding a coin for a gazillion years and never taking profit. There's just so many things that just don't make sense when you break it down logically. But because of the outcome that you can expect to experience when it's true, you become blinded to reality. Logically speaking, we know these decisions don't make any sense. But when you want something to be so true, you'll find any story you can that fits your narrative and you'll run with it. So the next time you're considering an investment, ask yourself 2 questions. What's the worst case scenario that can happen and how would that affect me? And secondly, what's the likelihood of this actually happening? Don't just assume things will work out for you and that everything will be fine. Because if there's one thing that I've learned about life, it's that most things don't go as planned. And that's the end of the video, guys. If you enjoyed it, make sure to check out my last video where I show you how I plan on turning £5,000 into £100,000 over the upcoming crypto bull runs. Take care, guys, and I'll see you next week.